to get customers the opportunity um, to get sustainability energy projects. And, with that, I'd like to have him explain what he does. And he's going to tell us about how green structures develop uh, their market and how they pivoted in their market space in the last year. So Spencer, thank you.
Thank you, Doug.
Yeah. Hey, Doug. Hey, everyone. Good afternoon and good evening. As Doug mentioned, I'm Spencer Wells. I'm the VP of Project Development here at Green Struxure. And really, I guess to start on a quick background on myself, as Doug had mentioned, I've been in this space for about 10 years, mainly focused on the clean power market and the renewable market segment of what we call behind the meter generation. And so what that distills down to is, and kind of physically looks like the installation of solar PV and battery storage on customer facilities. So done a lot of work between a number of different market segments, food and bev, biotech, real estate, office space, kind of anyone kind of falling in a larger power behind the meter user, and what we consider to be the commercial and industrial segment of the energy market. So my job day to day really is to develop customer proposals and relationships, really kind of on the front lines of working hand in hand with the customer to answer questions about the technical arrangement of the project, to walk them through the financial cash flows and the modeling of the project, and ultimately arrive at a construction contract or a long-term power purchase agreement, or what we call an energy services agreement. So I kind of run the gambit, have a lot of crossover in different segments of the business. So it's a very fast-paced environment. I've really enjoyed the work that I've done. So today I just wanted to give a high-level review of kind of Green Struxure, our market, and kind of how we started the business, why we started the business, and kind of get into some of the market segments and some of the pivots we made recently based on some of the regulatory and kind of energy landscape changes that we've observed that are rapidly changing on a almost a quarterly basis here in the US. So with that, let me share my screen and let me walk you through the deck. Can everyone see this okay?
Yeah, looks good.
Okay, great. So I'll just give a quick macro trends of what we noticed, and this is even going back before the company's founding, out of in pre-COVID, kind of in the 2019, 2020 era. But really what we've seen are really four major trends that we have really kind of set the stage for how and why we developed the business. One, we've seen a pretty large increase of utility prices. So the price per kilowatt hour that customers are paying, and many of you that are living in California specifically have seen a pretty rapid rise of cost increases that utilities have passed on to the customer. And so this is really affording the financial and the economics of these projects, the payback periods, the project investment cash flow models to look very attractive. Two has been a huge rise, I would say notably in the past two years, of sustainability and clean power prices. And this has to do with virtual PPAs and the big, large solar farms that large corporations are buying clean power in bulk. Think about Amazon, Google, Facebook, Meta. They all have thousands of terawatt hours of power they need to buy. And so we've really seen a huge uplift in these kind of market leading companies setting the stage for other companies following. And so there's a huge demand for what we consider clean energy power, which is the 100% renewable power generation that's supplying these facilities and helping meet corporate sustainability goals. So, over the last 6 quarters, we've seen the VPPAs are up about 40% and continue to drive up. And there continues to be a pretty large shortage of just the overall capacity of clean power that's being provided to these corporations. So that's really, again, set up the stage for more and more companies adopting these rules and adopting ESG targets that they're aiming to meet. The third boost that really helped the industry and our addressable market really increase was the passage of the IRA, or the Inflation Reduction Act, basically a set of regulatory federal incentives, specifically the federal tax credit, or what they call the ITC, or investment tax credit, that really has spurred a lot of investment. Previously in 2022, this tax credit was set to sunset and kind of level off at a much lower incentive value than what was passed in the IRA. So that really helped. And then number 4 is really just the local grid and utility landscape. There continues to be a big shortage around, again, capacity issues, with a lot more customers needing power, the electrification of fleets and vehicles, as well as a lot of other products that are moving from fossil fuel sources to fully electric inputs. And so there's going to be there's a massive shortage of the just grid operators being able to provide power to customers. And this has spurred a lot of incentives that the utility operators are incentivizing customers to start installing their own capacity and paying handsomely a handsome reward for that. So this kind of spins us into sets the stage for how. Go ahead,
Spencer. If you could go back to the last page, just for those of us who are uninitiated, describe DSGS and DEBA.
Sure. Yeah, these are specific grid. They're battery energy storage incentives in California. DSGS stands for the demand side grid support, and DEBA stands for the distributed energy backup asset. And these are specific incentives targeted at customers to install energy storage at their facilities. And the utilities are paying them on a per kilowatt capacity metric to perform and to support the grid in what they call critical events. So think about, the middle of summer in LA, everyone's running their HVAC, it's 110 degrees out. The grid's really under strain. And so the utility operators are paying customers to install their own storage systems that can start dispatching power to the grid at these critical times to make sure that they don't have to move to some other.
Maybe I shouldn't have asked that question.
More critical brownout. Again, these are just incentives that the utilities are paying customers to do these projects. It's really boosting the financial ROIs of these projects. Does that answer your question, Jay?
Yes, thank you. Thank you.
Okay, great. Sorry. So I'll keep going through here, and I'll get to our addressable market here quickly. But so Green Struxure set up our company. We call it energy as a service, but the key concept to understand is that Green Struxure, we invest and own these assets that are installed at customer sites. We pay for all the installation, and we also take on all the operating and maintenance of the assets. And then we sell that power generation back to the customer, and almost think about it like a second utility on their site, because they buy power from PG&E and SCE and SDG&E, and they pay these per kilowatt hour and per kilowatt fees to the utilities as they currently exist. We're kind of coming in as a second utility. We're supplying that power, and we're aiming to do that as on a more cost-effective basis, as well as being 100% sustainable. So that is really the energy as a service, or as a service construct. And we've developed our kind of 2 offerings out of this. We have our base offer, which is what we call our signature offer. And that's really around the installation of solar PV panels on the customer facility, as well as the implementation of an energy storage system. So that's what we call our on-site zero carbon energy delivery. And then our bill optimization, which is around the battery energy storage system, managing the customer's peak demand. We also provide a sustainability service in which we help report all of the customer scope 2 electrical emissions through our digital platform called Beyond the Grid. So that's really the core offering, and then we kind of start to build and upsell from there. We have an ultimate package that includes resiliency. So if the customer needs to be able to island from the grid or is experiencing a number of outages and it's disrupting their process, we can actually provide power when the grid goes down. We can also help them evaluate electrifications of their fleet. So adding level 2 and level 3 EV charging in the transportation sector and logistics. It's a big, very hot topic right now down in the Inland Empire. And then the last piece is providing a power quality product that makes sure, again, that the power that's being delivered from the utilities is going to be and from our system are going to be clean and going to provide a non-interruption without any type of frequency or voltage sags. We're making sure the customer's operation and critical products are always going to be up and running. So that's really the way the business was constructed. And again, the reason why these 6 services were picked were because it really hit, I think, the biggest addressable market that we saw in the market, and in terms of the clean energy market, as well as some of the microgrid and the resiliency and backup needs that customers were asking for, as we see more and more of these historic weather events and power outages across the country. So that kind of leads us into our target market, which again is focusing on an addressable market of what we had estimated to be about 200 terawatt hours. And that might not sound like a lot, but if you think about the way to use power at home, it's measured in kilowatts. A terawatt is on a 10x multiple of that. And so we're talking about a massive scale of usage. And again, I talked about the shortage of clean power in the United States that is currently happening. So that was really that set the basis of, you know, our goal as a company is to try to capture 3 to 4% of this market. And that would give us, you know, in the order of magnitude of about probably anywhere from, I would say, 2,000 customers that we could go and chase. Most of these customers are in the energy intensive, and just the use case profile of the industry is focused on the customer segments in consumer staples, food and beverage, biotech. And then so that I would say is our core market segment. And then we have recently added Mush, and Mush is municipal utilities, schools, and hospitals. So that's kind of another federal space that we are addressing on top of kind of this commercial, industrial, more privately owned sector. And then the third market that we've really put more resources into in the last 6 months is REITs, which stands for Real Estate Investment Trusts. These are the companies that actually own and operate the real estate and distribution centers and logistics spaces that space is growing extremely fast as more and more of the economy is going to kind of drop shipping and warehousing of product.
That's a correct question.
Sure.
On this, how much traction are you getting? And, you know, in our region here in Inland Empire, logistics is one of our larger industries. And over the years of trying to help are the startups that the climate tech startups that we mentor get into those customers, we have had a really hard time. Have you been getting traction with the building owners in the warehousing space here in the region?
Yeah, so that the tenant landlord relationship is something that's always a little bit more challenging to figure out when you're installing these on-site systems. But I will say, especially over the last year and a half, there's been a new piece of legislation passed from the South Coast Air Quality Management District called Rule 2305. And that is essentially the Air Quality Management District is mandating all of these warehouses and logistics distribution centers to electrify their fleets. And that's really driving, you know, it's either you start to pay and invest in this, or they're paying a fine per year. So it's really forcing the hand of these companies to take action, whether that's going to be the installation of on-site, that has to be the installation of on-site electrification. So level 2, level 3 charging, changing over yard trucks to be electric, changing over forklifts from propane to electric, and the biggest one being Class A trucks to electric. So that's really been a huge driver to now the actual real estate owner is having to get involved, because if the tenant is not going to be doing anything, like these 3PL and logistics companies that are leasing the space, they're going to be the one paying the fines. So more and more tenants are asking for clean power, they're asking for electrification, and that's really forcing the landlord to step up and get into the game and figure out a construct that's going to work for them. So we have been seeing a lot more success just by the fact that these, new pieces of legislation that have come out that are really forcing, landlords to offer these types of products to their tenants.
That's great news. Thanks.
Yeah, no problem. So again, I think our total addressable market, we started out on about 200 terawatt hours. Our goal was to, provide 3% of this market. But again, a terawatt hour is a massive amount of, this is a pretty unfathomable amount of power. And so again, our initial approach into the industry was to target these commercial, industrial, kind of Fortune 500 private companies. And then we have recently started to shift into the REIT space as well as the mush market. And the reason that has been is just because of these legislations that are being passed. California, I think Newsom just passed another SB piece of legislation that mandates companies over $1 billion in revenue disclose their carbon data and their scope 2 and scope 1, 2, and 3 emissions. And so there's definitely a lot of tailwind moving into companies pushing into going net zero, setting targets, and taking action. And that's been trickling into the federal space, the mush market, as well as the REIT space that I had just mentioned. I'll kind of fly through these last two slides here, but our original entry target into these states was really around the incentives. So where are we going to have the most amount of financial benefit to the customer that's going to want them to to sign contracts and move forward with deals. So our original top 5 states, or actually our top 3 states that Green Struxure actually started with, was California, New Jersey, and Massachusetts. And the reason these 3 states were picked was because they delivered the most amount of positive financial benefit to the customer. And then over the last 2 years that we've seen utility prices escalate by almost 30 to 50%, it's widened our scope of our addressable market to include Texas, Illinois, Arizona, Connecticut, and New York. So we've really expanded our addressable market from our original 3 states. Now we're looking at projects in 10 states. Another driver of that is just some of our initial customers that we've signed contracts that are national companies also have locations in some of these markets that we're just going to follow. We have a contract signed. We have a customer that's already under contract, and then we want to move forward into another site, and they pull us into the market where they have their portfolio located. So that's just maybe kind of like a shift that we've seen, and maybe kind of took us outside even of what, expediting some of these states that we had originally not anticipated to work in. And then as we do that, we're getting more educated on those states, the incentives and the financial models and the sustainability benefits that can be provided to other customers in those states that, that are prospects to us. So that's really helped widen the scope there. So yeah, I think that's probably a good overview of how I think Green Struxure's kind of evolved our target market. And then really, again, we're always trying to position ourselves against our competitors to provide a more holistic solution. Again, I talked about the 6 services that we provided. I think we're the only player in the market that's really providing all 6. There's a couple of our other competitors that maybe do 3 or 4 of the 6 that we provide, but we definitely feel that this gives us not only the widest addressable market, but a lot of competitive advantages when we go in and we are competing against our competitors to be able to provide additional upsells that provide more value to the prospect. So I think that's maybe a pretty good ending point for me. again, thank you guys for having me and give me the opportunity to give you some insight into green structure. So I'm happy to take any Q&A at this time.
Thank you, Spencer. Galen, looks like you've got your hand up, and then any students or other participants after Galen.
You know what? Thank you, Jay. Why don't we let the students go first? I don't want to take up their time. Thank you, though.
Dimitri?
Yes, thank you, Spencer, for the nice talk, and I'm sorry if I missed it because I had some technical issues, so I had to restart my Zoom. But the question I have for you is that, is there any incentive for your company to actually modify buildings and make them, nature-based, so that you actually decrease your microgrid needs, so making your building more efficient? So is green structure only providing what's needed to the company, the building, or do you also have that role of modifying the building itself so that it also needs less of this energy?
Yeah, great question. So green structure is only in the business of providing on-site power. We are a joint venture with Schneider Electric, who's one of the largest energy distribution companies in the world. They have a specific group of that deals with energy efficiency, I think is kind of what you're referencing. So actually going in first and helping just reduce the overall customer baseline usage, right? So the installation of LED lighting, of other smart controls and HVAC systems, that you're physically able to just lower what they actually use on an annual basis, and then coming in and sizing a microgrid to address the rest of the load. So hopefully that answers your question. Green structure actually doesn't perform a lot of the energy efficiency, or you'll hear it referred to as EE opportunities. We have a different division within Schneider Electric that handles those types of projects. We're really focused on the delivery of on-site power through our microgrid. So the solar generation, the battery storage, any other type of backup assets that we're attaching to the microgrid, like a generator. So we don't actually perform the energy efficiency side.
So based on your answer, it seems to me as a business investment that you will be limited in time in the future. And I don't know the market, but from the standpoint of as a scientist, the way we see it is that the energy demand will be pushed to be decreased for each customer, whereas your goal is to keep it the same, but to make it green. So do you think that eventually your business will have to be shifted, or do you consider that into your equation of business?
Yeah, great points. So just to maybe clarify, in terms of the actual overall usage that we can typically address, I'll just pick like a food and bev manufacturing company that we've worked with. These sites are using, hundreds, millions of kilowatt hours per year. And typically when you look at the square footage of what's needed to supply 100% of their load, there's usually never enough space on the site. So in most cases, the microgrid supplying probably anywhere between 25 and 50% of the load. And that's just maxing out the available space the customer physically has to install solar PV modules. So when you look at the energy efficiency side and you look at the total addressable customer load, we're only taking a pretty small portion of that relatively to their overall usage. So there's still plenty of opportunity even post the installation of an on-site system for the customer to come in and look at other efficiency measures just to continue to lower their baseline. But most of these larger facilities, you would need 10, 30 football fields to be able to supply 100% of their load, which is usually not going to be feasible. So I think we fit very well because we're usually only providing a portion of the power. We're not going to be able to provide everything. And so the customer still has the opportunity to address the rest of that load through energy efficiency products.
Thank you.
Any other questions from the participants? If not, I've got a couple.
Yeah, so you're out of Boston, right? The original startup.
Correct.
So do you have any, just a couple minutes on, I don't know when you joined, were you one of the original founders, or did you join after it had scaled quite a bit, or any advice on these very early stage climate tech startups that are in this program for very early, any kind of very early stage advice for how to get going?
Sure. So yeah, I started about 6 months into the inception of the company back in 2021. So I was one of the first kind of key leadership hires over on the West Coast. Yeah, I mean, I think, you know, we've obviously, I think every startup makes mistakes about, you know, the getting off the starting block. You know, our leadership team really wanted to come to market with like a fully baked product and something that was, you know, fully ready to go. And you know, I think there's advantages and pros and cons of doing that. I think, you know, looking back at Green Structure's kind of getting to this point we are now with getting our services set up. I think we probably spent too much time in some of these other services that we're not selling as much, where we should have been spending time on, hey, what does the customer want? What gets the contract signed, and where are we seeing the need the most? And so that again really goes into you know, that kind of shaped the process of being able to execute more quickly on our signature offer. And that signature offer really didn't come out, you know, I would say in at least, we call it Green Structure 2.0. But that took us about a year to really say, hey, like most customers just want this. They don't want their maybe as a phase 2 or phase 3, they want resiliency and they want to add more hardware and more cost to be able to do islanding and other things that the microgrid can do to benefit the site. So I would say, you know, the advice that you know, looking back, is just to really focus on what those initial customers and what that addressable market is really after to start, and then build the service line from there. I think Green Structure kind of came in trying to have a fully baked solution for all 6 of these. And we probably spent more time developing certain of these offers around resiliency that we really hadn't gotten a lot of traction. Even to date, it still kind of is a more of a phase 2, you know, phase 3 sell for us. So hopefully that gives you some good advice there. But that's,
Yeah, that's
probably
great.
a stumbling block that we made, you know, right out of the gate.
What does powered by beyond the grid mean? What does that mean?
So Beyond the Grid's our digital platform that we use to aggregate all of the project data. So it's a customer experience platform that they can log in on their web, on a web-based tool, and they can actually view all of the production of the microgrid, of all of their financial performance in real time. It's basically a digital repository of the project. It's a digital twin of the assets, and it's a place the customer can go to interface with the assets.
Cool. Thanks.
Okay, Galen, you're next. Then I think Eric has a comment.
Yes, thanks for joining us tonight, Spencer. 2 quick questions. One, whatever you can say about Texas non-proprietary as far as being a target market. I find that of interest personally.
Sure.
And on behalf of one of the UCR students, startups in another program, what advice do you have for a startup that wants to work in this space, and they're trying to determine whether to target consumers, which you guys have a footprint in, and sounds like financing their equipment, versus going directly to a municipality, a local municipality, and trying to partner up with their incentive program? Thoughts on that from a startup student perspective?
Sure. So I'll answer your first question just briefly on Texas. Texas is a really interesting market. If you look at it from a technical vantage point, Texas is actually an energy island in the U.S. Most of the U.S. electrical grid is actually fully connected from East Coast to West Coast. Texas is a market where they physically are electrically separated from the rest of the states in the continental U.S. So that kind of inherently builds a lot of issues around you know, grid balance and capacity. And so what we've seen in Texas over the last, I would say, 2 years, specifically after that big freeze event that happened in 2021, was that they needed to install more distributed energy assets. Texas was very concentrated with, just a number of kind of gas and oil peaker plants that were running most of the grid. And now they're seeing the shortfalls of not being able to install more solar and storage to be able to kind of diversify their energy mix. So with that has come, over the last 3 years, Texas prices are up, I think, about 50% from where they were in 2019. And the reason that is because of the capacity shortfall, but the cost of natural gas and oil has gone up substantially as well. So the financial incentive for customers that were paying, 4 to 5 cents a kilowatt hour there now are paying 12 to 13, and the investment case for the project just penciling more. And the Texas market has also come out with a lot more grid operator incentives for customers to install generating assets on their facility. So again, it's kind of catching the tailwinds of all these, other incentives I had talked about. Federally, the IRA, the Inflation Reduction Act, is definitely helped a lot of the investment cases in Texas with the increase in the tax credit value. So that's kind of, I think, Texas market is definitely becoming much more financially attractive than I would say it was 3 years ago, and that's really forcing more customers to start to look into these projects where they weren't recently. I'm sorry, I forgot your okay. Sorry. Your second question was about going after
Yes, a
municipalities.
startup. Yes, from a startup perspective, going after the consumer, the home consumer with energy savings versus going to the local municipality, which offers incentives, as you know.
Yes.
Yeah, I'll leave it at that.
A lot of these probably just have to go back to your understanding of the cash flow model of the business, and the cash in versus cash out, and the development process that takes place in order to sign revenue. Municipalities is going to take much longer. You have to go through several steps, and you have to go to public boards to get approval. Your sales cycle is going to be very long, although the project value can be very big. When you're dealing with consumers, like on the residential side, that sales cycle is going to be much faster. The deployment and the capturing of revenue is going to be on a much more rapid cycle. So it just depends on how you have the business structured, and being able to anticipate those types of sales cycles. On the municipality side, we've done a number of projects with Montgomery County. These projects typically take 9 to 12 months to develop and contract. So you're talking about 12 months to just get to a contract, and then from there you're building an asset. On the residential side, you're probably talking weeks, if not shorter than that, to sign a contract. So it just depends on how you have the company structured, and what the product is, and what the needs that you're filling for each of those types of customers. But I would just be mindful of the sales cycle on the federal side. Municipal side is going to be much longer than what you would see on the consumer or residential side.
Thank you.
Spencer, I've got a couple of sort of closing questions that are related to the coursework that we have. And I was hoping you could answer that. One is for the founders, and maybe even yourself, how did they go about evaluating the market and market size to determine that it was a large enough market or markets to enter? And so we're asking students to do the same thing, figure out how big the market is and that sort of thing. That's the first part of the question.
Yeah, so Clark, who was originally supposed to be doing this, was part of the founding 5 founders of Green Structure. He could probably answer that a lot better than I could. I know it's just some initial stats that they looked at, kind of the total, they looked at the addressable, just the solar market, right? Not even talking storage and some of these other assets, but the solar market that they were looking to address, and the evaluation of, and we were just looking at the commercial and industrial size. So we weren't talking residential, we weren't looking at utility scale. In 2022 was about 25 billion. I think in 2021 was about 15 billion. And now in 2023, we're looking at 100 billion. So they were really targeting, can we get a piece, just a couple percentage of, that C&I commercial and industrial market. And so that was I think the initial assessment they had put together. and setting up the targets and goals and the revenue goals of the company was based off of the commercial and industrial addressable market and mainly the solar behind the meter solar segment of that total energy kind of clean power market.
Thank you. The second part of that question was, and you've answered this already, but just not from this perspective, how important in evaluating the market were the government regulators and energy policies in your decision?
Yeah, I mean, I would say it's definitely one of the top three drivers. The renewable energy space is heavily incentivized federally. So to give some more color, back pre-2022, when we were still under the old regime of the federal tax credit was beginning to sunset. It started at 30% of the gross investment price. So you had $1 million project, $300,000 of that was subsidized from a federal tax credit. And
there you go. Yeah.
That was a huge piece. And then as that sunsetted, so in 2022, it stepped down to 22. And then in 2023, it was supposed to step down to 10%. And so when the Inflation Reduction Act passed last year, that re-upped the tax credit to 30%. And it is sustaining that tax credit through 2032. So we have another 9 years of incentive value to pull on. And that's really providing.
Yeah, thank you for saying that. And so for 2 weeks from now, when we have the ecosystem slide, this is the sort of thing that you want to look at. What are the variables, the stakeholders who can impact and positively or negatively influence your market? And before we go, if you would just go back a slide or two, next week's assignment is the competitive matrix.
Oh yeah, let me go there.
And so this is a pretty good one, folks. So if you want to replicate this, then that's pretty good. So I just wanted to point that out. Everyone saw it, but that's exactly what the assignment is for next week's, is to create your own one of these. And I know we could keep talking for a long time because Spencer is so interesting and he's got so much to teach us, but I'm gonna, if it's okay with everyone, move on to the next part of class, which is to have our breakout sessions. And I know that Doug was helping with the preparation of that. And so I also put down in Basecamp which groups you're part of. But Doug, are you available to
yeah, I'm here. Spencer, thank you very much. I know that
thank you everyone.
Overtime. We appreciate it, and I think you did a great job. Thank you for stepping in.
Let's give him a big round of applause.
Thanks for having me.